It is 2024, and let's review the 2023 market developments. This slide shows that global growth has surprised to the upside. Wall Street economists were generally very negative on economic growth in 2023, but over the full year, economic growth was above 2.5%, and economists are slowly revising up their growth forecasts. Consumption was the main driver of economic growth. From this chart, you can see the components of GDP growth. Consumption contributed 68% of the growth, followed by government spending, investment, and housing. In 2023, we also see the job market remaining strong. Job openings are moving down but are still at high levels, while jobless claims and the layoff rate are low. Labor supply has also improved, normalizing from the pandemic. Immigration was strong for Western countries, led by Canada, New Zealand, Australia, and the UK. One main positive development is inflation, which has mostly surprised to the downside. The global 3-month annualized inflation is already close to 2% for the GDP-weighted G10 economies. Looking at U.S. inflation, the Fed's preferred inflation measure PCE is at 2.6% as of November. The 6-month annualized rate and 3-month annualized rate are close to 2%, which is the Fed's target. In 2024, inflation will likely approach the 2% target. Given these market developments, growth stocks generally outperform value stocks, and large cap also outperformed small cap stocks. However, over the last month, small caps rallied strongly, given the Fed Reserve's indication to cut rates in 2024. The FOMC expects modest growth in 2024, which is 1.4%. The consensus growth outlook remains weak. Bloomberg Consensus Economic Growth expects 0.8% growth in 2024. However, some Wall Street banks expect higher growth, such as Goldman Sachs, expecting growth to remain at around 2%. This is consistent with real income growth of 3% in 2024, which can be broken down mostly into wage growth, job gains, and interest income, as the labor market is still robust and inflation is moderating. Inflation will likely go down below 2.5% as of March 2024, and the market generally expects the first rate cut from the Fed to happen in March as well. Historically, based on the past 70 years of market cycles, if there is no recession, the central bank may cut rate up to 150 basis points on average. But if there is a recession, the Fed may cut rate up to 250 basis points on average. If there is no recession in 2024, the Fed might cut 100-150 basis points in 2024. For the S&P 500 index, the earnings growth for 2023 is close to 0%, while for 2024, the market consensus is expecting 11% earnings growth. For 2025, the consensus earnings growth is 12%. The stock market also is not expecting a recession. Valuation for the U.S. is a bit higher. The S&P 500 index is now trading at around 20 times earnings, while Japan, Europe, and China are trading at much lower valuations. It is also noted that the earnings per share for the US, Japan, and Europe are moving up, but China earnings are expected to be flat. For the U.S. stock market earnings, the high valuation is mostly from the top 10 stocks, with a forward price-earnings ratio of 27, while the remaining stocks have much cheaper valuations, with a forward price-earnings ratio of 17. As the U.S. top 10 stocks are mostly large-cap high-growth stocks, the high valuation could be justified at a high growth rate. If 2024 economic growth is positive and there is no recession, the stock market valuation may stay at high levels or even expand from here. Even though the U.S. stock market delivered around a 25% return in 2023, the total mutual fund and ETF fund flows are not very high. In 2023, the total mutual fund and ETF flow is only $170 billion, much smaller than 2021, which is close to $1 trillion inflows. Compared to the stock market, the fund flows to money market funds are much larger, around $1.3 trillion. The open question is if the Fed cuts rates in 2024, the money market fund yield will go down. Do we see some outflows from money market funds and inflows to the stock market? 2024 is also the U.S. election year. Based on the long history of election year stock market patterns, the stock market could see some weakness in the first half of the year, while strength in the second half of the year, especially after the election. This chart highlights the election year stock market performance. The green area is the year with positive returns, while the red area highlights the years when the full year return was negative. It can be seen that in those 2 years when the stock market return was negative, it was in 2000 and 2008 when the economy was in recession. If 2024 is a normal recovery year, which is likely based on the current market developments, the stock market in 2024 will likely still have a positive return. But a weak first half of the year and a stronger second half of the year could be the base case here for the stock market.